Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, welcome back to the Market Minute today. We're diving into one of the hottest investor debates. Should you buy the dip? We'll break down market trends, the recent pullback in the Magnificent Seven stocks, and what's really driving inflation and gold prices right now. So we are going to have a conversation about tariffs, spoiler alert. And plus, we'll take a look at consumer sentiment and kind of how that's impacting different things. So Scott, let's start with this. When you hear the phrase buy the dip, what's the first thing that comes to mind about buying the dip?
Yeah, so first thing that comes to mind is, has the market truly troughed out? How close are we to the bottom of a particular selling cycle? Because the idea of buying on the dip is, hey, stock prices are now affordable. We have blue light specials on a variety of stocks, and
blue light specials. That takes
that's going way back, right?
Yeah.
So, that's not a bad time to be buying stocks that you're interested in, but you don't want to do that too prematurely. You're not going to time it perfectly, but you don't want to err on the side of being too premature with that buying.
Okay. So have you seen the strategy work? Does it sometimes backfire?
Sometimes backfires. There's also another adage in market circles that says, don't catch a falling knife.
Yeah.
And if something's falling precipitously in value, you don't want to be too early to the game with buying that security.
All right. So talking about kind of what buying the dip means, right, is if we get market pullbacks and what's driving the pullback isn't necessarily the value of that stock is less due to the fundamentals of the business. In other words, they're still they're profitable businesses. Their earnings are good, but there are other factors that are driving the value of that stock to be less. There could be good opportunities to go in and pick that up, like you said, Kmart Blue Light Special style. I think that's an interesting concept, right? We saw some of that taking place a few years back in 2022 with some of these stocks that were being kind of suppressed due to interest rate movements, especially some of those growthy names. But these were really good businesses, and they were actually doing really well from an earnings perspective, like companies that post-COVID had kind of a significant boom, like the Amazons and Netflixes that were more relied on during a pandemic period. And there, you could argue were some really good buying opportunities during that market pullback.
Yeah, there's another market adage that says markets sell first and ask questions later. Yeah. And to the extent that's occurring today, there might be some opportunity there. If some of the turmoil that we've seen around tariffs and other economic factors ends up being overwrought and overstated, it could be, hey, these underlying businesses are still phenomenal, and here's an opportunity to buy them at a pretty good level.
I think that ties into, Warren Buffett said something along the lines of be fearful when others are greedy and be greedy when others are fearful. And we're seeing a lot of fear right now.
Yeah.
And I'm not suggesting that means, now's the absolute right time to go out and buy, but it is something to consider to say, when people get really scared of what's happening, it might be an opportunity to slow down, evaluate the environment and the landscape, and then make a decision about, there's certain opportunities today. And one thing I'm really careful of here, Scott, is I don't want to ever abandon kind of tried and true financial planning principles towards saying, hey, let's go and overweight our portfolio all in one sector that seems to be, oversold. We've got to stick to our knitting on especially retirement planning, where it's like, hey, just because there are certain asset classes that do appear to be oversold, we need to be careful. The term that we'll often use as dry powder, right? So meaning if I've got dry powder, cash and other assets that aren't necessarily being spoken for, can I buy on the margins?
Yeah, yeah, yeah. The other thing I think on this, and Paul, I think this analogy will ring true with you because our kids are similar ages. If you've ever taught a teenager to drive, you get on a freeway with a
Yeah.
teenager, and when they do a lane change, they want to do this,
Yeah.
right? Where we
You
know
gotta get
it's
all the way off the exit,
yeah,
four lanes over.
yeah, we know like, hey, subtle adjustments are
Yeah.
what we're looking for, and it's the same thing with our portfolio. I can't think of any instances where it's, hey, we want to have a big visceral move and fundamentally shift the portfolio in a drastic way. Typically, when you make adjustments, they're very much subtle and they're on the margins. They're not big visceral changes.
Yeah, absolutely. So when we look at this, how should investors differentiate between a temporary dip versus a fundamental shift in market conditions?
Yeah, no, that's a great question. I think you have to dive into kind of what the underlying thing is driving the dip. In this case, right now, it's uncertainty with economic policy. And I think when we do have a little more clarity on kind of where economic policy is going, I think there can be a little more conviction as far as markets go. I think right now it's still touch and go as far as where some of these policies are going to land.
Yeah.
And as such, it might be a little premature to be, betting too heavily directionally one way or the other.
Fair enough. So the sectors of the market that got the worst of this over the last several weeks have been the ones that we kind of saw coming a mile away, and that was the overbuying of the Magnificent Seven. Tech giants that had led the market for the last 12 to 18 months. They've seen a more significant pullback recently. And we talked about, what is driving that? We talked about the uncertainty of this kind of political landscape, right? And I think the market wants predictability. The market wants to be able to say, we know how the math works to value these businesses, but we can't account for variables that are unknown. And that causes a lot of, anxiety and frustration. Have these stocks fundamentally changed, right? Or is this more noise?
I think the answer is yes. So I do think, if you recall, probably a month ago, DeepSeek, which is a Chinese AI tool, came out and it was displayed, hey, it has similar capabilities relative to USAI and doing it for a fraction of the cost and with far less computing power. And so that, kind of caused some consternation with NVIDIA investors and some of those other companies that are deeply invested in AI. The other question that's out there is, hey, has there been an overinvestment in AI? Have there been too many data centers that have been built, and has a lot of that demand been brought forward? And so I think there's just naturally some of that in addition to the elevated PE ratios that we're seeing in this space. Now, to be clear, technology over time moves one way, and that's up and to the right.
Yeah.
So you want to have that as part of a long-term holding in your portfolio. But I think investors are looking and saying, hey, are there any kind of cracks in the foundation of these companies? And in addition to that, with some of the economic turmoil, I think it's been a kind of convenient excuse to push the sell button.
Yeah, and I think one way I like to always look at this is I try to zoom out a little bit, and I try to look at some of these businesses and, Amazon, for example, and I think, do I know firsthand 5 people that don't use Amazon on a weekly basis, right? And the answer to that is I don't know 5 people. And I ask that question to clients all the time. And I say, do you know 5 people that don't use Amazon every week? And the answer usually is, I don't know 5 people that don't use Amazon almost daily. And so when I look at it from that perspective, and I think in terms of, is it a good time to buy? I always want to understand, what am I buying? And I know the landscape that we live in can get pretty scary. And that definitely needs to be accounted for and put into the equation. But will Amazon be worth more or less in 5 and 10 years than it is today?
Yeah.
And that's one way to always analyze, why we try to remain steady at the helm when it comes to certain investment opportunities. So let's shift gears a little bit, Scott, and talk about tariffs.
Yeah.
And I think this is definitely a topic on everyone's mind because this is probably what is driving some of the upheaval in the market today. So let's go ahead and share a screen here.
Yeah, and as as we begin this tariff discussion, Paul, I think it's important to note this is a very hot political topic, and we have zero interest and zero desire in weighing in on this politically. What we want to have is an economic discussion specifically about the mechanics of how tariffs work, and historically speaking, how tariffs have impacted markets and economies.
Absolutely, it's vital for everyone to understand that these things have impact on investing, which then has impact on retirement planning. We have no interest as advisors on weighing in on any of the policies that whether we think these are good or bad is completely irrelevant from a political perspective. And so as we go through this conversation today, it's absolutely crucial that everyone understand this isn't about a political opinion. It's very much about how these things work and what it potentially, what its impact potentially could be on our retirement plans.
Yeah, absolutely. Yeah, so that being said, we wanted to kind of walk through a basic example, very basic example of how tariffs work. So you can take any product. In this instance, looks like the slide has a bottle of wine, but let's say that bottle is priced at $50. If a $10 or 10% tariff is assessed on that product, the new price is $55. So with that $5 increase in price, the person kind of selling that product has a decision to make. With that $5 of additional cost, they can absorb that, cut into their profit margins, or they can pass that on to the consumer. And historically speaking, a little of both typically occurs. There's some compression of profit margins, but there's also a fair amount of that price increase that ends up being passed on to consumers. So tariffs end up being a de facto tax. They're a tax, they're a tariff tax certainly, but they also end up being a tax on consumers because some of those tariff costs end up getting passed on to consumers.
And I think the fear here is how much ends up getting passed on to the consumer, because historically, I think what you're saying is maybe we saw more of that burden being borne by the companies, but is there an appetite today for our consumers to be willing to take on more? And I think in COVID maybe demonstrated an appetite to say we can raise our pricing and let the consumer bear that. And the consumers did.
Yeah.
So there's a fear that says, okay, well, if these companies now know that, they might be willing to pass more of that on forward. So here's another version of this.
Yeah, so this one just shows kind of the nuanced complexity that we have around global supply chains, and this actually shows one that's not too complex, but I think it illustrates the point. And so you can see pistons that become part of an engine. Those go through a fairly complex supply chain. So the aluminum goes from Tennessee to Pennsylvania. They turn the aluminum into rods. Those rods are then shaped and polished in Canada, so it crosses the border there. And then from Canada goes down to Mexico, and then from Mexico, final refinement occurs, and then those pistons become part of an engine in Michigan. And so these supply chains have been built out over decades, and so there's a lot of work that goes into these, and there's a lot of complexity. Companies are looking at tax rates, they're looking at labor costs, they're looking at logistics and a number of other things to really optimize these supply chains. And as consumers, we've been the beneficiaries of these because the complexity has lent itself to lowering costs for complex goods. Paul, I've heard you use the example of, if you bought a flat screen, 70-inch TV 20 years ago, what would that cost relative to what it is today?
Yeah.
And so with a lot of goods, the complexity here has brought down costs. And so the concern here is, to the extent those supply chains get upset and costs are added when border crossings occur, the concern is that could be inflationary for consumers.
Well, Scott, let's keep this conversation going. And to do that, I'd like to welcome on today Fritz Foltz with us. He's fan favorite. He's been backed by popular demand. He's always fun to have on. He is the chief investment strategist for 3Edge Asset Management. And Fritz, as we talk about tariffs and their impact, we're seeing a resurgence of these tariffs and ongoing inflationary concerns. How do you see these factors influencing the market?
Well, it's been an exciting month or month plus, and I have a quote for you to get us started. And the quote says that there are decades when very little happens, And then there are weeks when decades happen.
Yeah.
And I feel like that's what we've been through. I mean, you know, as you explained, I mean, tariffs are pretty straightforward, right? I mean, they're basically taxing, putting a tax on imported products, and it's straightforward. So that's not the problem. The problem with tariffs is the potential for unintended consequences, right? And the way you think about the tariffs that have been introduced by the Trump administration, I feel like you know President Trump is trying to gain something by imposing these tariffs. And what we think it is potentially is a negotiating tactic, such that he says that, and in fact, puts these tariffs in place with the hope that those countries, Canada, Mexico, China, that have had these tariffs imposed on them will begin to make concessions, and then the tariffs can come off. And it's really more than anything a negotiating tactic.
Yeah.
The problem is, if that's not the way it goes, the unintended consequences, and frankly, what we've seen happen at the outset, is the party that you've put these tariffs on retaliates. And that's when you get into what you were talking about, a situation where you have tit for tat, tariffs back and forth. You have the potential for a trade war, and that is certainly going to be inflationary.
Yeah, and I think we saw some reflection of that in the Federal Reserve commentary and kind of meeting comments yesterday. What were your thoughts on that, Fritz, as they kind of unpack that?
So I think that, during the press conference, it seemed to me that Jay Powell was trying to sound calm and cool and say, listen, we've got this. But I think what you also heard, and because he said it, was that what they're seeing is slowing economic growth and rising inflation expectations. So they potentially could be in a bind here if we see the economy slow, which would mean they'd like to lower interest rates. But if inflation doesn't come down, then lowering interest rates is less of an attractive option. So I feel like they could be stuck between a rock and a hard place. I feel at the meeting, he did what he was supposed to do, which was just to say, we've got this, the economy is strong enough, inflation is coming down, it's okay, it will all be all right. But the other thing that he said was the economy is slowing and inflation is not coming down to target as quickly as they would like. And then, of course, last night, President Trump, through his Truth Social, put out his thought, which was the Fed should just lower interest rates because that would be the best course of action in advance of the more tariffs going into place.
Yeah.
Yeah, and I thought it was interesting because, like, in their own kind of technical fashion, they almost raised the specter of stagflation, as you've kind of articulated, Fritz, where we could have a period of time where inflation is elevated and we also see a slowing economy. It has been interesting if you look at our recession indicators; those have started to tick up. J.P. Morgan is calling for a larger probability of recession, still far less than 50%. But those types of discussions weren't in the arena even 3-4 months ago. What are your thoughts on the possibility of a recession?
Well, so we do believe that investors are a wee bit too complacent about these tariffs, and maybe assuming that, this will be, as I said earlier, this will be a negotiating tactic. The other sides will relent, and the tariffs can come off, and everything will be fine, and then the U.S. will be treated more fairly than we have been in the past, and that's the optimistic scenario. But we're very concerned about the potential for stagflation, which we haven't had in 50 years. I mean, 50 years. And so a lot of people who are managing money, they've never experienced it before. But you have,
Let me interrupt real quick. Just
yeah,
in the spirit of trying to make sure we're getting everybody at home who's not an engineer, who doesn't have a degree in finance, explain stagflation.
Sure. So stagflation is a really bad place to be. And what it means is the economy is slowing and you could be going into a recession. And some people will say, well, you can't have inflation if the economy slows. But in the 1970s, we proved that wasn't the
Right.
case. You can have that. So in a stagflationary environment, the economy slows. So if we use tariffs as an example, and this goes on and there's trade wars and these prices increase and consumers are really stretched and these things happen, that can slow the economy. But at the same time, prices are higher because someone has to pass along the cost of those tariffs onto the consumer. And so you have a slow economy, perhaps a recession. At the same time, you have inflation. It's a very difficult place to be. Now, one of the things that is possible in that environment, there are some asset classes that do well, including gold, commodities, and TIPS, US Treasury inflation protected securities. Those are the small handful of asset classes that can actually do well in that environment. But it's a very difficult environment. And we don't have to get there, right? We could have a slowdown a little and maybe inflation comes down more slowly. It doesn't have to happen, but you at least have to be able to start to think about that and how you might position yourself.
Well, then that was kind of one of my questions then. So, for investors, kind of where do they feel it the most when it comes to tariffs and inflation? Stocks, bonds, commodities.
Well, clearly, stock markets, your equities are not going to do well in a stagflationary environment. So, and the problem is the slowdown in the economy is going to get your stocks, and the inflation is going to get your bonds. So neither your stocks nor bonds do well, and that's why you have to be diversified beyond your stocks and bonds for that type of environment. You have to hold some real assets again. Gold is a good asset class to hold. You can hold commodities and these treasury inflation protected securities, US treasuries. They can also be effective, and also just very short term, high grade cash equivalent type vehicles. So that would be the universe of investments to hold for that environment. And as you know, we always hold some real assets in our portfolio.
Fritz, as you talk about commodities, would you lump energy in as part of that discussion?
So yes, so a couple of things on that. So the way that we look at commodities and real assets, oftentimes when we want exposure to a wide variety, a basket, if you will, of commodities. We're not necessarily energy experts. There are times when we might want to be overweight or underweight oil, for example, but more often than not, we just want a diversified basket of commodities because they are oftentimes treated fairly equivalently in the market, and it's not something that we are necessarily experts in each, agriculture, oil, and all the different components. So if you get into an inflationary environment, if you hold a broad basket of commodities, you will do better. You'll do well in that environment without having to choose. I mean, the whole deal with the oil prices, that's another wild card, because if we have something in the Middle East that flares up and becomes, a problem, you have this issue with the Strait of Hormuz. Does Iran close the Strait of Hormuz and spike the price of oil? So there's a lot of geopolitical uncertainty right now as well.
So I read a book recently that talks about, how to try to see the other person's perspective effectively. You've got to argue for the other person's side. You kind of flip roles, right? So let's play devil's advocate for just a minute. Let's make a case against gold. Why would gold not be a good asset class in today's environment?
Sure. So gold is not necessarily a good asset class if you get rising real interest rates, right? So real interest rates are simply nominal rates adjusted for inflation. And when real interest rates are rising, then rather than be in gold, you'd rather be in fixed income vehicles, right? Because your gold doesn't pay you interest, it doesn't pay you a dividend. It really just sits there on this shelf. And what changes is the amount of paper money it takes to buy that gold. And so if real interest rates are rising, meaning you're actually earning a rate of interest over and above the rate of inflation on your fixed income vehicles, then you would rather hold those than gold in that environment. So that would be my argument there.
And I guess a follow-up question on that, Fritz. I know for the past several years, we've had a lot of retail interest in gold, but a lot of sovereign buying of gold as well.
Yeah.
From what you're seeing, is that demand abating or slowing down at all, or is it still kind of full steam ahead?
Yeah, it seems to us as full steam ahead, and that central bank buying in particular is still there. And I think a lot of that comes from the fact that what we're seeing is the potential for the world to shift away from globalization and towards a more multipolar world. And there are certainly countries out there that want to de-link as much as possible from the US dollar as the reserve currency. And so one way to do that is to, instead of holding US treasuries with your excess reserves, you can buy gold, because at that point you've de-linked from the US dollar. One reason to do that, for example, if you're China, if you saw what happened with Russia when they invaded Ukraine, we froze those assets. And so to the extent that they were holding US treasuries, we could freeze those. That would not be the case with a country holding gold. So I think that as more and more countries try to be less reliant on the US dollar for reserve currency, that will keep the interest high. And I think sovereign nations will continue to accumulate gold.
Let's have a quick conversation on maybe U.S. debt. Just I think it's an interesting conversation and probably pretty relevant. I always like to explain the difference between debt and deficit, right? So the debt is the deficit rather would be we have spending of about $7 trillion and we only have the actual tax revenue base of about $5 trillion. So that means every year we have about a $2 trillion deficit, meaning how much money we spend that we don't have. And that money then adds to the national debt, which as of when I clipped this screen yesterday afternoon, it was $36.6 trillion. And then we look at the budget items down below, right? And those budget items down below, which are Medicare, Medicaid, Social Security, defense, and then unfortunately the amount of interest we spend on that debt, kind of the point you were making a moment ago, Fritz, countries buying our treasuries, we have to pay interest on that. That accounts for, what is that number, Scott? 70?
It's about 70% of our spending annually is already kind of earmarked for these specific purposes.
Yeah. So as we talk through this, does this have any anxiety, Fritz, from aiding in that conversation on gold or tariffs?
So for gold in particular. So we are concerned about the size of the debt and the size of the interest payment on that debt. And the reason why gold could be something that could protect you is we may reach the point, I'll explain this, we may reach the point where in order to pay back the debt, the government puts in place something called financial repression. And all that really sounds horrible, but all it really means is they're keeping interest rates artificially low, because then it's easier for them to pay off the debt. That interest payment that you pointed to will be smaller. And so that's what people say when they say they're going to inflate their way out of debt. And in an environment like that, real interest rates, which I mentioned earlier, will come down, and gold will be a very good asset to hold in that environment. I mean, at some point, we're going to have to pay the piper here. There are many ways to do it. Financial repression is certainly one of them. And if we get into that environment, then you're going to want to hold gold.
Yeah. And when we look at kind of the idea that we can make a big dent in this, I always think it's interesting to kind of zoom out a little bit. This is the amount of revenue that has historically been produced by tariffs, right? Where we're knocking on the door historically of $100 billion in revenue. If we were to somehow take that, Fritz, and I think maybe the most generous estimate would be double that, right? So we're looking at 200 billion in revenue. We're basically acknowledging that that's not going to cut it, right? That's not going to make a dent in the $2 trillion deficit spending. And even if Doge gets in there and says, hey, we're going to cut spending on our end, there's going to have to be other mechanisms that we look to address this deficit.
No, that's absolutely right. And I think probably maybe the most likely is this idea of pushing interest rates artificially low just to try to bring down the interest payments.
We appreciate you taking a minute to be with us here, Fritz, and help us expand some color and context regarding tariffs, inflation, and gold. So with that, we'll let you run. Appreciate it.
Thanks, Fritz.
Thank you very much. Always a pleasure to be with you guys.
So Scott, some final takeaways. If there's one key takeaway from today's discussion for you, what would that be?
I think a key takeaway, Paul, is that these are uncertain times, and when times are uncertain, we need to err on the side of being really well diversified. And that doesn't mean just planning for adverse scenarios. The conversation with Fritz kind of focused on some potential adverse outcomes. We need to potentially plan for the flip side of that as well, because there are potential scenarios where the turmoil we're seeing right now could be relatively short-lived. And if that happens, we could see markets rally in a material way. In that case, you don't want to be 100% kind of in a bunker, battening down the hatches. You still want to have some exposure to equities, but it is also prudent to kind of hedge and be well diversified. So if anything, this is a time to err on the side of being really well diversified.
Yeah, and those that get worried about market volatility, what's the best approach to stay steady and not get caught up in the hype?
Yeah, so there's a couple things. One thing that people will often do during these periods of time is they will get wrapped up in looking at the daily fluctuations and gyrations of the market. That typically isn't healthy. So maybe unplugging a little bit, not being as connected. If you have a good financial advisor who's keeping an eye on things, someone is minding the store and watching things, so you probably don't need to be as plugged in. The other thing I would say is we've had several years of really strong markets. Last two in particular have been really good. And so some people have become desensitized, if you will, to the idea that markets have volatility. We're in correction territory, which is about a 10% drop. That's not unusual by any stretch.
We talked about this yesterday. It's like, we're in 10% territory, and that's unfun. Nobody likes that. The average intra-year drop every year is 14%.
Correct.
And for whatever reason, this is one of these moments where I think there's just a lot of anxiety around 10%, but that is, by any statistical measurement, completely normal.
Correct. Yep.
And I had a call years ago, and this is going to sound a little tone deaf, so I want to preface it with I'm not trying to be insensitive. This is people's retirement money, and they take it very seriously, and I can appreciate that and respect that. But I had a call a couple years back, and there was another one of these moments in history where markets were very volatile. People were feeling a lot of anxiety about that, and I understand that, and it's totally justified. But some of the best things we can do, to your point, is maybe not get too caught up in paying such close attention that we feel the need to pull the fire alarm every single morning, because that can really disrupt our own peace of mind and well-being. And this individual was feeling this constant just turmoil and frustration and anxiety. And it was really disruptive to her retirement. And I said, she said, what do I do? How do I fix this? What are the things that I need to be doing to get rid of these feelings? And I said, what are your favorite hobbies? And she kind of chuckled and said, I love to knit. And I said, then turn off the TV when you knit. And she said, that's it? And I said, that's it. Turn off the TV when you knit. And I think that'll help. And sure enough, a couple months went by, that moment passed, and what was going on in the geopolitical world had passed. And she reached out and said, is it over? And I said, I think we've kind of gotten through that particular issue. And she said, good, I wasn't paying that close attention. Once you gave me that advice, it was really, really helpful.
Yeah. Yeah, 100%. And then I think the other thing I would add, if you're finding, hey, understand all that, but I'm still a little bit anxious about what's happening. Sometimes it's not a bad idea to let a little bit of air out of the tires. And what I mean by that is, we can trim your portfolio a little bit with the risk assets, move a little bit of money to more conservative positions, and not materially impact the long-term projections for your portfolio, but give you a little peace of mind feeling like, hey, I have taken a little bit of action, I have de-risked a little bit, but not in a, knee-jerk kind of visceral reaction where you're moving everything to cash or doing something that's going to harm you in the long run. Sometimes just dialing things down a little bit, reducing the speed a little bit can be helpful psychologically.
And to that point, it's reach out to your team here at Alliance Wealth so we can help you kind of know what options you've got. If it means de-risking, letting some air out of the tires, making some rebalancing, reweighting of the portfolio assets so they're more in line with where you should be. One of the biggest risks that we worry about is behavioral or reactionary risk. It's not that's self-inflicted wounds. That's not what the market's doing. That's how we're reacting, to the market. So Scott, that's all we've got time for today. That's it for today's episode of the AWA Market Minute. And remember to stay smart on your retirement journey. Know where you're headed, have a plan, stay steady at the helm, and travel with the trusted team who's been down that terrain before. Thanks for tuning in, guys. See you next time.